Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, Professor of Economics at Ewha Womans University. Professor Kim, thank you for coming on today.
Good afternoon, Devin.
So this is the Bank of Korea's second interest rate cut this year, the last one back in March when the pandemic was really picking up steam, down another 25 basis points. Tell us more about this decision.
Bank of Korea is implementing quite aggressive expansionary monetary policy to keep step with government's also expansionary fiscal policy. Today, Bank of Korea slashed this policy rate by a quarter percentage point to a record low of 0.5%. Of course, this rate cut is for stimulating economy as country's economy is expected to grow at the slowest pace after economic crisis of 1997.
Yeah, and speaking of growth, the BOK said it now expects GDP to contract this year by 0.2%. This is the first time it's said that since 2009. It's also the first such projection from a major public sector entity in Korea.
Bank of Korea today updated its economic growth rate forecast of this year from positive 2.1% in 3 months ago to negative 0.2% today. This huge change in economic growth forecast indicates that Bank of Korea expects COVID-19 shock will continue to hurt local economy down the road until next year. Bank of Korea also has added current situations of GDP components like consumption has remained sluggish, export has fallen significantly, and recoveries in the facility investment and construction investments are both subdued.
Yeah, and the government's trying to turn that around. As we often discuss here, there are concerns about the government's fiscal soundness going forward if it does go ahead with a third big budget for this year, and it is planning to do so. So what do you make of that?
Since coronavirus pandemic is hitting Korean economy very hard in an unprecedented way in its scope and its strength, it is necessary to increase government expenditure to revive economy. And government is about to turn in the third supplementary budget proposal to Congress, even though its size is not exactly known yet. But given the situation, the government's policies, top priority is given to expansionary fiscal policy and fiscal health issue became something forgotten. But before implementing expansionary fiscal policies, it is important to draw the limit of government debt increase because it is our children who is going to pay back today's government debt.
Indeed. Well, switching gears a little, it's shaping up to be a good week on Wall Street. Despite the tensions with China, all three main indices up on Wednesday. The Dow breaking through 25,000 for the first time since March. The S&P back up to 3,000. What's the story in the global markets?
As the United States economy has begun reopening and higher expectations on coronavirus vaccine development, U.S. market went up on Wednesday's market. Dow Jones Industrial increased over 2.2%, and Nasdaq also increased by 0.8%. And all European markets, including London, Frankfurt, Paris, increased over 1% on Wednesday. But Shanghai and Hong Kong markets all declined today due to escalating conflicts between Washington and Beijing.
And now Korean stocks started off higher this morning, but by around lunchtime that had turned around. What happened there?
In today's morning session, KOSPI and KOSDAQ all increased, and that was led by chip producers like SK Hynix and Samsung. But in the afternoon session, domestic markets turned to downside, even with Bank of Korea's interest cut. And the domestic market ended with Kospi's negative 0.1% and Kosdaq's negative 2.2%. I think these negative returns are related to Bank of Korea's updated negative economic growth forecast for this year, and increasing possibility in China and U.S. trade war in the near future.
Indeed, it also seems the situation in the coronavirus has caused a little bit more alarm here at the moment in Korea. Professor Kim, thanks so much for sharing your insights with us today. We appreciate it.
Thank you very much.